Well, there's no question that China is already trying to cool things off, and they should. They're doing the right thing. They have raised reserve requirements 3 times. They've raised interest rates. They're putting on some pretty serious measures to cool off the housing bubble, which is developed in urban coastal real estate in China. So, yes, China's taking smart measures. It's not just China, though. Australia's raising interest rates several times. You know, we do have inflation in the world. Some countries deny it and lie about it, but we do have inflation. And so people are trying to cool it off. Will that have an effect? Of course. Whenever you cool off demand for anything, it has an effect in the markets. Will it cause the commodity markets to collapse? If it does, stock markets are going to go down a whole lot more because the fundamentals are much better for commodities than they are for stocks. Well, I'm not buying any stock markets anywhere in the world. I haven't bought any stock markets for the past 18 months. I have been playing this world economy through the commodity markets for those 18 months and the currency markets. And as I said, now I'm starting to sell short. But I have nothing to do with any Asian market. I just have not bought any markets anywhere because I have been leery of this big rally in the stock market. It's been caused by a lot of money being pumped into the world economy. So my view was, as I said before, if the world economy gets better, commodities will do well, and they have. If the world economy doesn't get better, commodities are going to be a better place to be than stocks all over the world, not just Asia.
Right.
Well, I was short the major Western financial institutions in 2008. I'm delighted and surprised you remember, but I was. Then there were great excesses in the Western financial community. We don't have that kind of excess now. We have excesses, but nothing like we did then. I'm just shorting this major Western financial institution because it's very high priced, and if the markets are going to consolidate, it will be one of the first to get hit, because the reasons that, in my view, we will have consolidation will be because of currency turmoil and financial market turmoil. I do not see a bubble in finance like we had 2 or 3 years ago. We could have one again, but it's not there yet. I only see two bubbles in the world. One is Chinese urban coastal real estate, and the other is the United States bond market, government bond market. We don't have major periods of excess like we did 3 years ago in the Western financial arena. Well, sugar's up 400% over the past few years. It depends on how you look at it. Yes, sugar's come down in the past few months, but that's the way markets work. I mean, this is Reuters Thompson. Don't you know how markets work? Markets do like this. They always have consolidations and corrections. I don't know that sugar. I didn't say buy sugar before. I was just pointing out to you that sugar is still probably 70 or 80% below its all-time high. It doesn't mean you should buy sugar. I'm just pointing out, using that as an example of how cheap many agricultural products are. But yes, you must be careful of markets. Now, this is Reuters Thompson TV, to repeat myself. You must know how markets work. Markets don't go straight up and they don't go straight down. They have, various and sundry consolidations and corrections along the way. If you're going to get involved in anything, you need to try to buy when they're down and not when they're up. Well, I'm not quite sure that you would see emerging markets slowing down if Europe didn't, if I understood you properly. Yes. If Europe and America slow down, that's going to cause the markets everywhere to have an effect. Europe and America, for instance, are over 10 times as big as the Chinese market. People talk about China, people talk about India, but these are very small markets or economies compared to the major economies in the West, and especially if you throw in Japan. So if the West slows down, of course, it's going to affect everybody. I don't see the emerging markets slowing down and the West reviving, because the West is so very, very big, and the West needs most emerging markets. Most emerging markets are commodity-based economies, and if the world economy does well, the commodities are going to do okay. So I don't see the emerging markets slowing down if the West continues to revive. I started selling short on emerging market index, but that's just because the emerging markets were the ones that went up the most in the past few months. Well, I don't pay that much attention to the Federal Reserve. The Federal Reserve basically follows the market. The market has a lot more money and a lot more power than any central bank, including the Federal Reserve. those people are bureaucrats that follow the markets for the most part. The market is already getting hesitant. As you probably know, long-term interest rates have been going up in the past few months. The long-term bond in America made its peak several months ago. So I would watch the markets more than the Federal Reserve if I were you. The markets are getting leery of all this money printing which has been going on. And as you know, central banks have been buying bonds in a huge way. Right. The market's getting suspicious and leery of that, including me. So right. I would suspect you will see higher interest rates in the next year or so. Well, Africa has more than 50 countries, so it's hard to talk about Africa as a whole, but I'm extremely optimistic about some countries in Africa. As you point out, there are huge agricultural interests in Africa. Yes, I'd much rather be invested in Africa than in some continents I know, so by all means. But again, you cannot just say a blanket invest in Africa. You've got to make sure you get involved with the right countries, the right people, and the right situation. But yes, as a gross generalization, I'd rather own Africa than not own Africa.